So, how's it going, guys? In today's video, we're going to be covering order flow, and I'm going to be showing you guys a simple 3-step criteria that I personally use to determine order flow, right? Now, the whole point of this video is to really dummy it down and make it very clear and easy to understand. So previously, when I've looked online or when I was learning at the beginning of my ICT career, I found that order flow was quite a touchy subject. Now, what do I mean by this? What I mean is that many people will have different methods of defining order flow, right? There's not one fixed method. However, there are similar signatures you can look for, right? So these signatures, I believe, are the most easiest ones that you can use to determine order flow. So getting straight into it with a bearish trend, there are 3 signatures that we expect price to respect. Now the first one are up candles. The second one, the thing that we need to be seeing, are highs being swept, right? This is manipulation in the market, and we want to see this opposing our direction. So if we are bearish, we want to see buy side liquidity or highs being swept in the market. Now the third and final thing we are looking for is for bullish ranges to be respected. Now this is not your typical bullish dealing range. You will see what I mean in a second when I show you guys this, right? So please don't get confused. Okay, so going back onto the charts, we're going to show an example on USD JPY, and this will be using a monthly PD array and daily order flow, right? So if we look on the monthly time frame, you can see we've ran above, very old highs. This overall is a market maker buy model. It is very extreme, but we are showing you that these concepts are fractal. They are working on very high time frames, right? This is a market maker buy model that essentially began in 1998 and finished in 2022. Now, if this isn't proof that the concepts work, I don't know what is, right? This is, hard evidence that these market maker models really do work. Anyways, so you can see we've ran this old high from 1998, and now price has left a bit of a rejection wick to the upside. But what we want to know is price going to continue going higher, or is it going to continue going lower? Now the way we're going to determine this is through order flow, right? There's no other way to determine this. We want to see where is the market driving to and what is being respected. So if we go into the daily time frame, what can we see? So we can see that after running this key high, we've closed past this fair value gap, and we've had a bit of a displacement lower, right? Price is beginning to shift lower. So let's play this out a bit. Okay, and here we are. We have massive displacement lower now. But what else can we see? We can see up candles are being respected. Let's change the color. Here we are. So here we have these up candles respected, this up candle respected, these up candles being respected. You can see price trades through them, trades back into it, and respects it before trading lower. Now, if we play this out even more, we have this overall range of up candles, right? This is what I mean by bullish ranges being respected. You can see we had this range of bullish candles trading higher, and then we traded lower with a closure beneath the range. Now we want to see this overall range being respected for a confirmation of downside delivery. And let's see what happens. We don't quite make it all the way back into the bullish range. If you did anchor it from this low, you'd see that it was respected. But me personally, I would have anchored it like this. But that's completely fine. Price just missed our area of interest and continued to go lower. So then what happens? We have a new bullish range being made, right? This, low to high price was bullish here on the lower time frame. This is bullish order flow. Then we trade lower, close beneath it, trade back up into it, and we trade lower. So once again, you can see this bullish range being respected, or the up candles are also being respected, right? What else do we see? Is this a high? No, this doesn't qualify as a high. But what we can see is these highs on a lower time frame are being wicked, and this FEG is being respected. So if we play this out even more, as you can see, we are getting that next confirmation in price. Highs are being swept, and we are trading lower. As you can see, we come back up higher again, and then we trade lower. So now we have a new, this old bullish range, these bullish up candles, we want to see that being respected. Until this fails, then we may have a change in order flow. So you can see price comes up back into the range if you mark it from this wick. Depending on your price feed, this may have been a tap. I think it's exactly perfect tap, right? So we tap into that and then we trade lower. We are still respecting the bearish order flow by respecting these bullish up candles, and the bullish ranges highs are also being swept. So we are going to keep following this order flow until we reach a draw on liquidity. Now, this sell side liquidity is a draw on liquidity. So after running this key level, you want to be careful and see if price trades above this old bullish range. Now, if we trade above this and, then we start respecting bearish ranges, perhaps we're going to this buy side liquidity pool or even higher. Okay, this is also a valid draw on liquidity for sell side liquidity. So let's play this out. Okay, we are still, raiding highs, trading above highs. Let's see if we can trade lower. We trade lower. So as you can see now, the bearish order flow is still being respected. Highs being swept, these up candles being respected, the up candles or the bullish ranges, similar thing. When I refer to, simple, just an up candle, I'm more referring to order blocks, right? So if you see in this overall price here, this single candle here, this is the up candle being respected, right? Whereas these are ranges. This is a range of candles, right? These range of up candles, this is what I class as a bearish range, sorry, as a bullish range being respected, right? So we can play this out even more. You can see your price trades back into the old bullish range, this push up, and we want to see if we can trade lower from here. Okay, and we fail to trade lower, right? And what's happening? So as we fail to trade lower, keeping in mind that we've met our sell side liquidity target, we want to see if this old bullish range gets disrespected, right? Whilst viewing that, what else can we see? If I just make this a little bit smaller, we can see this. Potentially now, this is a old bearish range. We traded higher, and now we want to see if these down candles are being respected also. This can be a way to spot a change in order flow, right? So let's play this out. As you can see, now down candles are being respected. These old bearish ranges are being respected. So perhaps this is a change in order flow to go bullish, right? So then this can be our next draw on liquidity. Let's play this out. Okay, once again, you can see this overall range is still being respected, or these down candles here, right? This whole bearish range has been traded through now. We trade back into it and it's been respected. So please note, these are the candles I'm referring to, right? These down candles, impulse lower, then we trade above and close through them. Now we trade back lower inside of them, right? And what else do we have? We have old lows being traded beneath and then reversing through, right? This is manipulation. We are seeing lows getting swept, and then once again we're closing above these old bearish ranges, and that should facilitate a bullish order flow. And as you can see, your price begins to go bullish. So that is a nice and clear example of a bearish order flow, which then switches to bullish, and those are the only three signatures we use. Okay, so moving on, obviously similarly to this, in a bullish trend, we expect down candles to be respected, as I just showed you guys. We expect lows to be swept, and we expect old bearish ranges to be respected, right? Or a range of down candles, if that makes it clearer for you guys to understand. Okay, so here we are back on USD JPY, and now you can see we have traded into this monthly fair value gap, and we have a nice rejection wick to the downside. So potentially I'm expecting price to trade towards this rejection block and then ideally the high. So let's go into the daily time frame and we're going to check if the order flow agrees with it, right? So currently we've displaced a lot lower and now we're beginning to trend a bit higher. So let's play this out. and let's see what happens. So we have this range of down candles, right? This old bearish range. And what we can do is change the color. So we expect this to hold on price if order flow is to continue bullish. And as you can see, price trades into this old area and then we trade higher, creating, new down candles. So this would be the order block, right? And this would be the range of down candles. So essentially, we're just waiting for price to trade back into this. And if order flow is correct, we should respect this and then trade higher. Or alternatively, the other thing we can do is sweep this low and then trade higher, right? But we shouldn't really trade lower and close beneath this low, right? So let's see what happens. Okay, we don't quite make it down there. Instead, we trade higher, we run a low, and we have these new range of down candles made, right? You can see we had this down move, price then traded higher, closing above the bodies of these candles. So here we have a new bearish range to be respected. Let's see if that holds. Okay, as you can see, price can trade beneath and wick the low, but we don't really want to see it close beneath the range, right? That is not an ideal scenario. But here we can see price trades lower, wicks the sell side liquidity, which is a signature, right? We want to see old lows being traded beneath and then price reversing the other way. So we trade lower, manipulating sell side liquidity, and now we should trade higher to continue the bullish flow. And as you can see, that's exactly what we do, right? And then we have this new sort of range. Okay, we come back into that, trade higher once again, and then we close above this old range. Now this should be the final range to be respected before we meet our draw on liquidity. And as you can see, we respect that and then we trade higher. So this is a very nice clean example of clean bullish order flow. Once you meet your first higher time frame objective, you really want to pay attention and see if the flow is still going in your direction. If you then, start to see these down candles being disrespected, price trading through them, and highs being swept, there's a potential change in order flow. So price could now be hunting for sell side liquidity or a old fair value gap, right? However, if you are still considering this high, what you want to do is you want to play out price. Obviously, in real market conditions, you can't play out price. You have to, allow price action to develop, and you still want to see these confirmations, right? These signatures and price. So, for example, old lows being traded beneath, but we still want these down candles to be respected. And if that is showing in price, then your draw on liquidity could still be valid, right? So let's play this out. As you can see, we run lows and we're still trading higher. We now have this new range of down candles, right? Price trades above, closing above the body once again. We trade back into the range, running beneath old lows, and then we trade higher once again. So now we have our final range of down candles, and we want to see if this holds to propel price to our final draw on liquidity. And see, we don't quite make it. Instead, what happens is we run this high and we disrespect these down candles. So now potentially this could be a change in order flow. So we could go lower from here, or if you refer to the time frame higher, this may just be a retracement, right? So this could just be a run on this sell side liquidity, respecting this down candle to then go higher. Let's see what happens from here. Okay, and then we trade lower, so we don't quite make it all the way to our draw on liquidity. So there we are. That is a clear example of a bullish order flow, towards our draw on liquidity. And then you can see towards the end, price does fail. We don't quite meet it. Sorry, we don't quite meet it. I think depending on your price feed, this may have been met, because it looks like we were about 2 pips away from meeting the target. So I think it is dependent on which broker or data feed you are using. So yeah, as you can see, once we reach this level, price then trades lower and we get them bearish signatures on price, right? So old highs being swept and then ranges of up candles holding, right? You can see this range, price trades through it, closure beneath, we trade back into it, then we trade lower, and then once again we have this range here, price trades through with a closure, then we trade back into it and trade lower. So that is a simplified way of viewing order flow, and that's all I personally use. So I hope that does help you. If there is anything else that you guys would like me to cover, please let me know down below in the comments. You know, this is a very powerful concept, right? But you have to piece it together with your higher time frame draw on liquidity and, you know, all the other concepts that are in your trading plan. You can't use this as a sole factor alone. So I hope that does help, and thank you for watching. I will catch you guys in the next video.